I'm not sure that people necessarily are worrying about the stability of their institutions right now, but I think they are worrying about not making enough returns on their savings, and that's ultimately the issue here. I also think that the bigger picture, the bigger issue for all of this is really a tightening of credit conditions, meaning if everyone moves their money from regional banks into large banks, those large banks are not going to be able to make up in lending terms what is lost by the smaller institution, and that means net lending ultimately goes down, which is actually what we're seeing in the US at the moment. That means tighter credit conditions, means borrowers need to pay a bit extra for the funds, and ultimately means a headwind and a slowdown for the economy. That, to me, is the bigger issue rather than necessarily individual banks failing.
That was quick then, wasn't it? I mean, we talk about monetary policy coming with a lag period. The credit tightening on the back of the banking story has been much quicker to come to the fore.
Yes, and the Fed is obviously now relying on that being sort of a substitute for rate hikes. They effectively went on hold, and the justification for that is that they don't need to hike rates as much if the banking system and the broader credit system is doing tightening on their behalf. Now, we might not be sure quite yet that is enough to slow down the broader economy, bring unemployment a bit higher, and all these things that are ultimately required to get inflation down again. But at least that's what the Fed seems to be betting on at the moment and concerned about.
Can you actually ascertain, what we're seeing right now adds up to the equivalent of a 25 basis point hike, for instance, or 50 basis point? Is there any way to ascertain the level of tightening and what it represents in terms of a basis point level?
I think that's really hard, and I'm probably not the right person to do it. But I can say that when you look at credit conditions, they are almost as tight as you would expect them to be going into a recession, whether you look at banks and their lending standards, or whether you look at the debt markets and how much they're lending to lower rated borrowers versus higher rated borrowers. On both of those metrics, we are at lending standards that are just borderline recessionary, and that tells you that credit conditions are pretty tight.
Viktor, we've got to let you go, but just before you go, can I just ask you one very cheeky question? How much protection should you be putting on using derivatives at the moment to mitigate against equity market downside?
So you're meant to own a bit of protection because, while the credit market has repriced a lot since last year, most of that's driven by QT and tighter monetary policy conditions. I don't think the credit market is pricing in much of a downturn at the moment, and that, if there is another leg of spread widening ahead of us, that's where it's going to come from.
You sound like a worried man. You feel the market's not got enough priced in?
I'm concerned that we need to go through another period of volatility in order to get to where the central banks ultimately think we're going to get to.